Everybody, today's hearing will examine the money laundering, drug trafficking, and terrorist financing risks created in the United States when a global bank uses its U.S. affiliate to provide U.S. dollars and access to the U.S. financial system to a network of high-risk affiliates, high-risk correspondent banks, and high-risk clients. Most international banks have a U.S. affiliate. They use it in part to compete for U.S. clients and business, but also to provide themselves with access to the U.S. financial system. Global banks want access to U.S. dollars because they are accepted internationally, they are the leading trade currency, and they hold their value better than any other currency. They want access to U.S. wire transfer systems because they move money across international lines quickly, securely, and to the farthest corners of the earth. They want to clear U.S. dollar monetary instruments like traveler's checks, bank checks, and money orders. And they want the safety, efficiency, and reliability that are the hallmarks of U.S. banking. The problem here is that some international banks abuse their U.S. access. Some allow affiliates operating in countries with severe money laundering, drug trafficking, or terrorist financing threats to open up U.S. dollar accounts without establishing safeguards at their U.S. affiliate. Some operate in secrecy jurisdictions. Some allow poorly managed or corrupt foreign banks to make use of an affiliate's U.S. dollar account. Others allow high-risk clients to use those accounts without taking adequate anti-money laundering steps. Some even allow those affiliates to pressure their U.S. cousins to ease up on U.S. anti-money laundering restrictions or look the other way when they spot suspicious activity. The end result is that the U.S. affiliate can become a sinkhole of risk for an entire network of bank affiliates and their clients around the world, playing fast and loose with U.S. rules. The consequences are the ones that you'd expect from operating a U.S. bank with inadequate safeguards against money laundering. The U.S. bank can end up aiding and abetting transactions that fund terrorists, drug cartels, corrupt dictators, and tax cheats, because all of them want access to the U.S. financial system too, and for the same reasons. Wrongdoers can use U.S. dollars and U.S. wire transfers to commit crimes, arm terror groups, produce and transport illegal drugs, loot government coffers, and even pursue weapons of mass destruction. That's why our country has made combating money laundering and terrorist financing a national security imperative. For the last decade, this subcommittee has contributed to the battle against money laundering and terrorist financing by exposing problems that increase U.S. vulnerabilities to abuse. In 2001, for example, this subcommittee released a report showing how U.S. banks that offer accounts to foreign banks engaging in what is known as correspondent banking can become conduits for illegal proceeds involving organized crime, drug trafficking, or financial fraud. Back then, most U.S. banks opened a correspondent account for any foreign bank with a banking license. After our hearing, U.S. banks took a harder look and assessed the risks before opening a correspondent account. In 2002, Congress cited our hearings when enacting tougher anti-money laundering, or AML, laws in the Patriot Act, including in that act a provision making it a legal obligation for U.S. banks to conduct a due diligence review before opening an account for a foreign bank. Tougher AML, or anti-money laundering laws, have helped deny criminals access to the U.S. financial system. But as our report that we're releasing today shows, enormous problems remain. To illustrate those problems, today's hearing focuses on a case study involving HSBC, one of the largest banks in the world. Headquartered in London, HSBC has a network of over 7,200 offices in more than 80 countries, 300,000 employees, and 2011 profits of nearly $22 billion. HSBC has been among the most active banks in Asia, the Middle East, and Africa. It first acquired a U.S. presence in the 1980s. Today, its leading U.S. affiliate, HSBC Bank USA, sometimes called HBUS or HBUS, that HBUS affiliate has now 470 branches across the United States and 4 million customers here. HBUS is the key U.S. nexus for the entire HSBC worldwide network. In 2008, HBUS processed 600,000 wire transfers per week. In 2009, two-thirds of the U.S. dollar payments that HBUS processed came from HSBC affiliates in other countries. One HSBC executive told us that a major reason why HSBC opened its U.S. bank was to provide its overseas clients with a gateway into the U.S. financial system. Now, on top of that, HBUS's history of weak anti-money laundering controls, and you've got a recipe for trouble. In 2003, the Federal Reserve and New York State Banking Department took a formal enforcement action requiring HBUS to revamp its anti-money laundering program. HBUS, which was then converting to a nationally chartered bank under the supervision of the Office of the Comptroller of the Currency, or OCC, made changes. But even before the OCC lifted its order in 2006, the bank's anti-money laundering program began deteriorating. In 2010 September, the OCC issued a supervisory letter, 31 pages long, describing a long list of severe anti-money laundering deficiencies, and followed in October 2010 with a cease and desist order requiring HBUS to revamp its anti-money laundering program a second time. The OCC cited, among other problems, a massive backlog of unreviewed alerts identifying potentially suspicious activity, a failure to monitor $60 trillion in wire transfers and account activity, a failure to examine risks at HSBC's overseas affiliates before providing them correspondent banking services, and the failure over a 3-year period to conduct anti-money laundering checks on more than $15 billion in bulk cash transactions with those same affiliates. To examine the issues, the subcommittee issued subpoenas, reviewed more than $1.4 million documents, and conducted extensive interviews with HSBC officials from around the world, as well as officials at other banks and with federal regulators. HSBC has cooperated fully with our investigation. The subcommittee's work identified 5 key areas of vulnerability exposed by the HSBC history. The 5 areas involve the following. First, providing U.S. correspondent accounts to high-risk HSBC affiliates without performing due diligence, including a Mexican affiliate with unreliable anti-money laundering controls. Second, failing to stop deceptive conduct by HSBC affiliates to circumvent a screening device designed to block transactions by terrorists, drug kingpins, and rogue nations like Iran. Third, providing bank accounts to overseas banks with links to terrorist financing. Fourth, clearing hundreds of millions of dollars in bulk U.S. dollar travelers' checks despite serious suspicious circumstances. And finally, offering bearer share accounts, a high-risk account that invites wrongdoing by facilitating hidden corporate ownership. Let's take each in turn. First, the issue of high-risk affiliates. HSBC operates affiliates in 80 countries, including jurisdictions facing major money laundering, drug trafficking, or terrorist financing challenges, as well as weak anti-money laundering laws and oversight. Yet, until recently, HSBC's London-based parent company, known as the HSBC Group, instructed its affiliates to assume that every HSBC affiliate met the group's anti-money laundering standards and automatically was told to provide it with correspondent banking services. HBUS did as told. It opened U.S. correspondent accounts for more than 80 HSBC affiliates, ignoring our law, the American law, requiring due diligence reviews before opening U.S. accounts for foreign banks. HBUS dealings with an HSBC affiliate in Mexico illustrate the money laundering dangers. HSBC Mexico, or HBMX, operates in a high-risk country battling drug cartels. It has had high-risk clients, such as casas de cambios, and it has offered high-risk products, such as U.S. dollar accounts in the Cayman Islands, a jurisdiction known for secrecy and money laundering. HBMX, or HB Mexico, also has a long history of severe anti-money laundering deficiencies. You add all that up, and the U.S. bank should have treated HBMX, the Mexican affiliate, as a high-risk account for anti-money laundering purposes, but it didn't. Instead, HBUS treated HB Mexico as such a low-risk client bank that it didn't even monitor their account activity for suspicious transactions. In addition, for 3 years, from mid-2006 to mid-2009, HBUS conducted no monitoring of a banknotes account used by HB Mexico to physically deposit billions of U.S. dollars from clients, even though large cash transactions are inherently risky and Mexican drug cartels launder U.S. dollars from illegal drug sales. Because our tough AML, or anti-money laundering laws in the United States, have made it hard for drug cartels to find a U.S. bank willing to accept huge unexplained deposits of cash, they now smuggle U.S. dollars across the border into Mexico and look for a Mexican bank or casa de cambio willing to take the cash. Some of those casas de cambios had accounts at HB Mexico, which in turn took all the physical dollars that it got, transported them by armored car or aircraft back across the border to HBUS for deposit in its U.S. banknotes account, completing the laundering cycle. Over 2 years, from 2007 to 2008, HBMX shipped $7 billion in physical U.S. dollars to HBUS. That was more than any other Mexican bank, even one twice HBMX's size. When law enforcement and bank regulators in Mexico and the United States got wind of the banknotes transactions, they warned HBMX and HBUS that such large dollar volumes were red flags for drug proceeds moving through the HSBC network. In 2008, after warnings from regulators, HBMX stopped taking large deposits of U.S. dollars. But for years, HBUS provided an easy gateway into our financial system for suspicious cash from their foreign affiliate in Mexico. Next, a second problem involves actions taken by some HSBC affiliates to circumvent a U.S. ban on bank transactions involving designated drug traffickers, terrorists, or rogue regimes such as Iran. To enforce that ban, the U.S. Treasury Department's Office of Foreign Assets Control, or OFAC, has developed a list of prohibited persons which banks use to develop what's known as a OFAC filter to identify and stop prohibited or suspicious transactions. The subcommittee found that for years, HSBC affiliates in Europe and the Middle East acted to circumvent the OFAC filter when sending U.S. dollar transactions involving Iran through their accounts at HBUS. Although they viewed these transactions as legal under a U.S. exception for so-called U-turn transactions, the affiliates did not want to trigger the OFAC filter and undergo the individualized reviews required to make sure that they were legal. So they stripped out or omitted any reference to Iran from the paperwork. An outside auditor hired by HBUS has found that from 2001 to 2007, HSBC affiliates sent nearly 25,000 transactions involving Iran worth over $19 billion through HBUS and other U.S. accounts, while concealing any link to Iran in 85% of the transactions. HSBC's chief compliance officer and other senior executives in London knew what was going on, but allowed the deceptive conduct to continue. While some HBUS officials in the United States claim not to have known they were processing undisclosed Iranian transactions, documents show that key HBUS officials were informed early on. HBUS compliance and payments executives repeatedly told HSBC affiliates that they had to use fully transparent Iranian transactions. But when faced with evidence that the affiliates were secretly circumventing the OFAC filter, nobody in HBUS confronted those affiliates, brought the issue to a head, and forced the transactions to light. Problems also arose when some HSBC affiliates tried to circumvent the OFAC filter to send potentially prohibited transactions involving other countries like Sudan or North Korea. OFAC programs are aimed at exposing and disabling the financial dealings of some of the most dangerous persons and regimes in the world, including terrorists, persons involved with weapons of mass destruction, drug traffickers, and rogue jurisdictions. The OFAC filter is the key to blocking prohibited transactions from polluting the U.S. financial system. Global financial institutions have a special responsibility to respect OFAC prohibitions, but that's not what happened here. While HSBC affiliates may have been aiming simply to avoid processing delays, circumventing OFAC safeguards can also facilitate transactions undertaken by some of the world's worst wrongdoers. A third issue involves the fact that HSBC is active in regions of the world with significant terrorism challenges, while demonstrating a worrisome willingness to do business with banks that have links to terrorist financing. One example involves Al Rajhi Bank, the largest private bank in Saudi Arabia. After the 9/11 terrorist attack on the United States, evidence emerged that the bank's key founder was an early financial benefactor of al-Qaeda and that it provided accounts to suspect clients. In 2005, HSBC Group told its affiliates to sever ties with that bank, but they made an exception for HSBC Middle East. 4 months later, without explaining why, HSBC Group reversed itself and said that all of its affiliates could decide whether to do business with Al Rajhi Bank. HBUS chose to close its Al Rajhi accounts. Over the next 2 years, however, its own bankers and bankers from other HSBC affiliates pressed HBUS to resume ties with Al Rajhi Bank, and in 2006, after Al Rajhi Bank threatened to pull all of its business from HSBC unless HBUS reinstated its U.S. dollar banknotes account. HSBC gave in. And over the next 4 years, HBUS supplied Al-Rajhi Bank with nearly $1 billion, U.S. dollars, stopping only when HSBC made a global decision to exit the banknotes business altogether. The fourth area of concern involves HBUS's willingness to clear suspicious bulk travelers' checks for foreign banks. From 2005 to 2008, on a regular basis, HBUS cleared $500,000 or more per day in bulk travelers' checks from the Hokuriku Bank of Japan. Routinely, these checks arrived in large stacks of sequentially numbered checks signed and countersigned with the same illegible signature. Forced by the OCC, the Office of the Controller of the Currency, to investigate, HBUS found that the Japanese bank could not provide any know-your-client information or any explanation of why 24 of its customers, supposedly in the used car business, were often disposing $500,000 a day in U.S. dollar travelers' checks purchased from the same bank in Russia. Under OCC pressure, HBUS stopped clearing the travelers' checks in 2008, but kept open the correspondent account, despite that Japanese bank's poor anti-money laundering controls. In less than 4 years, HBUS provided over $290 million in U.S. dollars to a Japanese bank for the benefit of Russians, again, supposedly in the used car business. Finally, there is HBUS's willingness to offer accounts to bearer share corporations. These corporations are prime vehicles for money laundering and other illicit activity by providing anonymity through assigning legal ownership of the corporation to whoever has physical possession of its shares. Over a decade, HBUS opened account for 2,000 such corporations, despite warnings by internal auditors and outside regulators that the accounts posed high money laundering risks. Documents show that the actual account owners deliberately pressured the bank to help hide their identities. One such account was used by a father-son team of Miami Beach hotel developers who were later convicted of tax fraud for hiding $150 million in assets. Bearer share accounts, suspicious travelers' checks, banks with terrorist financing links, hidden transactions, dodging OFAC safeguards, and Mexican drug money. None of them represent the types of transactions we want in a U.S. bank. If the parent corporation of a global bank can't do a better job policing its affiliates, we shouldn't be providing a bank charter to their U.S. affiliate. If the U.S. affiliate can't do a better job of standing up to affiliate pressures and safeguarding the U.S. financial system, federal regulators should consider whether to pull its charter. HSBC Group recently issued a policy statement declaring that all of its affiliates would be subject to the highest anti-money laundering standards among them, that its affiliates would start sharing information to strengthen their anti-money laundering defenses, and that all affiliates would be subject to diligence reviews. HBUS has more than doubled the size of its anti-money laundering compliance department, put in a new anti-money laundering monitoring system, and closed over 395 high-risk correspondent accounts. These are all good steps, but we saw that movie before in 2003. The recent commitments are welcome. Apologies and commitments to improve are also welcome. But accountability for past conduct is essential, and that's what's been missing here. It's bad enough that a single bank, such as HSBC, exposes the U.S. financial system to multiple money laundering risks. It's made worse when there's a failure of anti-money laundering oversight by the regulator which is supposed to oversee our biggest banks, the OCC. It is of great concern to the subcommittee, and it should be of great concern to every American, that the OCC tolerated the mounting anti-money laundering problems at HBUS for 5 years without taking any formal or informal enforcement action. In addition, when the OCC decided the problems had gone far enough, it lowered HBUS's consumer compliance rating instead of its safety and soundness rating. Every other federal banking agency treats anti-money laundering deficiencies as a matter of safety and soundness of the bank. Only the OCC treats anti-money laundering deficiencies as if they were a matter of consumer protection. Anti-money laundering safeguards aren't aimed at protecting bank customers. They are aimed at protecting the entire American public from wrongdoers seeking to misuse the U.S. financial system. The new leadership at the OCC needs to move swiftly to correct the previous oversight shortfalls and to assure that promised changes at HSBC are implemented promptly and effectively. Our report contains many recommendations to address the abuses that we've identified. Among the important are the following. HBUS should identify which of its sister affiliates are high risk, subject them to enhanced monitoring, and in particular, review whether it should close the account of HSBC's Mexican affiliate. HBUS should beef up its OFAC compliance program by auditing affiliate transactions to see if they are circumventing the safeguards that protect our country and other countries from terrorists, drug traffickers, and rogue jurisdictions. HBUS should close accounts with banks suspected of involvement in terrorist financing, revamp its travelers check controls, and eliminate bearer share accounts. HSBC should require affiliates to share information to strengthen their anti-money laundering defenses, and they should continue to beef up its compliance program, which was given such short shrift in the past. At the OCC, the agency should follow the lead of other regulators and treat anti-money laundering compliance as a matter of safety and soundness of banks. The new OCC leadership needs to get the OCC moving against money laundering by identifying statutory violations, not just identifying failures of banks as matters requiring attention in the face of significant anti-money laundering deficiencies. Global banks have caused the world a lot of heartache. Our focus today is on one global bank that failed to comply with rules aimed at combating terrorism, drug trafficking, and the money laundering that fuels so much of what threatens the global community. I want to thank my staff for their extraordinary work. I want to thank Ranking Member Senator Coburn, Dr. Coburn, for all of his support and for the work of his staff. And I now turn to him for his opening statement.
Thank you, Mr. Chairman. I normally submit an opening statement for the record and make a few short comments. I will not do that today because the gravity of the problem that we face, and I want to make sure my words are heard and part of the record. I agree with most of what we heard Senator Levin say. I want to thank him for his tireless work on this issue. I kind of know he's kind of one of my favorite bulldogs in terms of when he gets hold of something, he really doesn't let go of it. I don't always agree with the number of teeth that he loses when he grabs hold of it, but the fact is he does grab hold of it. I'd also like to thank the Office of the Control of the Currency and HSBC Bank. And the reason I'm thanking them is because in the years that I've been on this subcommittee and this committee, which is 8 now, I've never seen the type of cooperation that we got both from a government agency and a private entity. The OCC provided a number of people for interviews as well as essential documents about the regulatory process. HSBC bank officials likewise sat for dozens of interviews and handed over millions of pages of documents. Some of today's witnesses were flown in from posts around the world. As Chairman Levin has laid out in his statement, the subcommittee's investigation into anti-money laundering and anti-terror finance efforts at HSBC has covered quite a bit of ground. PSI examined in detail the types of vulnerabilities our nation faces, from criminals and terrorists who want to take it and abuse our banking system and take away our freedoms. What we learned is the United States faces some very unique risks, both because of our post-9/11 security needs and because of the strength of our financial system, which attracts worldwide attention. Every day, countless transactions denominated in U.S. dollars occur around the world. This is good for our economy, which benefits from a strengthened currency and increased economic activity. But criminals around the globe are also drawn to U.S. banks, which offer the attractive option of making illicit funds look legitimate. If they can pass criminal proceeds through a U.S. bank unnoticed and untouched, the funds are unlikely ever to be stopped or ever be recovered. This hearing raises the big and important questions. Banks want to obey the law, but also grow their businesses. What happens when the two goals conflict? Banks want to know their customers, but some customers want privacy. How do we resolve this? As we write AML policy, we should look for ways to get all boats rowing in the same direction, letting banks and government each do what they do best as we all work to combat crime and terror. At HSBC, we uncovered a number of troubling examples in which weak AML systems may have let criminal or terrorist funds pass through. In Mexico, for example, as the chairman said, billions of U.S. dollars flowed from the HSBC affiliate in Mexico. The Mexico affiliate was the single largest exporter of U.S. dollars in Mexico to HBUS. U.S. law enforcement and the regulatory entities have concluded that because of the volume of money, it likely came from the proceeds of illegal drug trade. Not a far assumption. In another case, an Iranian bank was allowed to initiate U.S. dollar transactions that HSBC would process through the U.S. without explaining where they came from. At the time, however, there were severe legal restrictions on any payments coming from or going to Iran, most often meaning that they would be manually inspected. HSBC's affiliate in London coached the Iranian bank on how to get the payments through the U.S. without inspection, and simply requested the bank send transactions that would not violate U.S. law. In effect, it relied exclusively on an Iranian bank to comply with a law intended to catch payments from Iranian banks. The bank or the officials that made the decision were either naive or willfully blind. This is why tough anti-money laundering laws are important. If illicit funds can be tracked and stopped, there are fewer places for criminals and terrorists to hide. And while our focus has been on the problems we found at HSBC Bank, we also have to emphasize that similar problems exist at other banks. For example, Citibank, Bank of America, Wachovia, Western Union, and others have come under scrutiny for laundering drug cartel profits. The purpose of this hearing, then, is not just to make an example of HSBC as if it were an anomaly. Rather, this hearing is to help Congress understand what kind of risks this nation faces and what we should do to reduce them. If we can get a better handle on the risks by looking closely at the operations of a single bank, we can write better laws and achieve our true goals, stopping crime and preventing terror. With that in mind, I believe there are several lessons we can learn from the problems that we uncovered at HSBC Bank. First, banks operate around the world under different laws, creating different sensitivities to money laundering. While this seems apparent, it was not clear how much this would affect a bank with worldwide affiliates until we took a closer look. In the case of HSBC, its bank in the U.S. operated differently even than its own affiliates in London, Mexico, and the Middle East. Failure to recognize this can lull us into thinking we can rely on foreign banks to carry out U.S. law. Second, bank regulators are sometimes better at identifying money laundering vulnerabilities than knowing how to fix them. Throughout this inquiry, it became clear the Office of the Comptroller of the Currency was aware of many of HSBC's AML weaknesses, which it frequently pointed out. It was often at a loss, however, to prescribe how HSBC could eliminate the weaknesses. And so its record of enforcement at HSBC resembles a lapdog rather than a watchdog that we sorely need. We've also learned recently that investigators from Treasury's own Office of Inspector General have cited OCC personnel for unethical practices. This, unfortunately, does not seem to be an isolated incident. We will go into greater detail in that as we see the facts unfold. Taken together with our subcommittee's findings in this investigation, these conflicts are startling and suggest Congress should give closer scrutiny to OCC's actions. The purpose here is to stop criminals from hiding their illicit funds and preventing terrorists from having the freedom to plot and plan. The metrics we use to measure a bank's AML compliance need to focus less on form and more on substance. How well are we achieving our goal? This committee has shown this committee has shown the kinds of vulnerabilities that we now face. Too often what we found left us very troubled, both for the risk to our nations and for the level of effort we saw to eliminate them. HSBC made its share of mistakes, for which it's now being held accountable. But what we must all remember is that money laundering always begins with a crime. And this ultimately is what we mean to fight. To the extent that this hearing results in criminals and terrorists having fewer options to rob and harm the public, we will count it as success. It may be impossible to stop all money laundering. Most of what we call money laundering in certain contexts is a benign transaction in another. Buying travelers' checks is innocent behavior for the tourists, but suspicious behavior when they are purchased in bulk by terrorists or drug lords. This does not mean we should not try to stop criminals from laundering their money through U.S. banks, but we need to do so wisely. I appreciate the efforts that HSBC has made thus far to improve their AML systems, and I sincerely hope they stick. I look forward to hearing from our witnesses as well as from the OCC and appreciate their appearance before us today. Thank you, Mr. Chairman.
Thank you very much, Dr. Coburn. I'd now like to call our first panel of witnesses for this morning's hearing, Honorable David S. Cohen, the Undersecretary for Terrorism and Financial Intelligence at the U.S. Department of the Treasury, and Lee Winchell, the Assistant Director for Investigative Programs at the U.S. Immigration and Customs Enforcement, ICE. I very much appreciate both you being with us this morning. We look forward to your testimony. Pursuant to our Rule 6, all witnesses who testify before the subcommittee are required to be sworn. So at this time, I would ask you both to please stand and raise your right hand. Do you swear that the testimony you're about to give before this subcommittee will be the truth, the whole truth, and nothing but the truth, so help you God? We will use a timing system today, and about 1 minute before the red light comes on, you'll see the lights change from green to yellow. And that'll give you an opportunity to conclude your remarks. Your written testimony, of course, will be printed in the record in its entirety. So please try to limit your oral testimony to 7 minutes. Mr. Cohen, we're going to have you go first, followed by Mr. Winchell. And after we've heard your testimony, we'll then turn to questions. So please proceed, Mr. Cohen.
Thank you, Chairman Levin, Ranking Member Coburn. Thank you for inviting me to testify today. I am pleased to have the opportunity to discuss the importance of the Treasury Department's efforts to identify and combat money laundering and terrorist financing in the U.S. banking sector. At the outset, it is important to recognize that the United States maintains one of the strongest and most effective anti-money laundering and counter-terrorist financing regimes in the world. This is a testament to the work of the Congress, including this subcommittee, the regulators, the enforcement agencies, and the financial institutions themselves. But the scale, efficiency, and sophistication of the United States financial system, particularly its banking sector, make it a prime target for those who seek to conceal and move illicit money. This involves not just money launderers, of course, but also terrorists, weapon proliferators, drug lords, and organized crime figures, who all at some point rely on the financial system to store, move, and launder the funds supporting or derived from their operations. Treasury's ability to protect the integrity of the U.S. financial system from abuse and to combat critical threats to our national security and foreign policy depends to a significant extent on the implementation by U.S. financial institutions of robust programs to prevent money laundering, terrorist financing, and sanctions evasion. This morning, I would like to briefly address why effective anti-money laundering, counter-terrorist financing, and sanctions compliance programs are so critical to our national security and the integrity of our financial system, as well as some of the steps we are taking, along with our partners in Congress, the executive branch, and internationally, to improve the effectiveness of our anti-money laundering, counter-terrorist financing, and sanctions compliance regime. Although it is difficult to measure with precision, by any estimate, the total amount of dirty money moved through and concealed within the U.S. financial system is massive, in the hundreds of billions of dollars annually. The sheer volume of money moving through the banking system in particular makes banks both the most vulnerable financial institutions from money laundering and terrorist financing and the most important line of defense against money laundering and terrorist financing. Our regulatory framework, overseen by Treasury's Financial Crimes Enforcement Network, or FinCEN, along with the federal functional regulators, was built to require financial institutions to implement risk-based anti-money laundering programs to collect and report useful information to law enforcement and national security authorities for the purpose of combating the full range of illicit finance. This regulatory framework assists banks in identifying and managing risk and creates the foundation of financial transparency required to apply targeted financial measures, such as sanctions against specific actors or prohibitions against specific activity. To implement targeted financial sanctions, banks must screen clients and transactions against the Specially Designated Nationals list, the SDN list, maintained by the Treasury's Office of Foreign Assets Control. This is a list of drug traffickers, weapons proliferators, terrorists, officials from rogue regimes, and other threats to our national security whose U.S. assets are frozen and who are generally forbidden from engaging in any transactions in the U.S. financial system. Despite the importance of robust anti-money laundering and sanctions compliance programs, recent civil enforcement actions by OFAC, FinCEN, and the federal banking regulators illustrate that sometimes financial institutions fail to implement adequate programs, exposing the U.S. financial system to significant risks of money laundering and resulting in illicit actors gaining access to the U.S. financial system. We have seen, for example, an instance where a bank failed effectively to monitor its correspondent banking relationship with high-risk customers, resulting in the processing of $420 billion in cross-border financial transactions with 13 high-risk Mexican casas de cambio from 2004 to 2007. We have also seen several cases where foreign banks stripped out the names of Iran or other sanctioned entities in wire transaction messages routed through the United States, resulting in billions of dollars of benefits to sanctioned parties. These and other similar cases have resulted in criminal fines and forfeitures of more than $4.6 billion over the past 6 years. These cases raise important questions about vulnerabilities in the framework of anti-money laundering and counter-terrorist financing requirements that require immediate attention. As a result, Treasury is working closely with our interagency partners and the private sector to better understand the compliance challenges faced by financial institutions, clarify U.S. government expectations of financial institutions, and strengthen the overall anti-money laundering and counter-terrorist financing regulatory structure. In addition to continuing to impose sanctions on weapons proliferators, narcotics traffickers, transnational criminals, human rights abusers, and terrorist financiers, my office is also focused on improvements to our regulatory framework. One of our most important initiatives is to examine whether the customer due diligence rules, the foundation of financial transparency, should be improved. Earlier this year, FinCEN issued an advance notice of proposed rulemaking suggesting ways to clarify, consolidate, and strengthen customer due diligence requirements for financial institutions, including an obligation to collect beneficial ownership information. We are also focused on combating the use of shell companies and other opaque legal structures that facilitate illicit financial activity. We strongly support legislation requiring disclosure of beneficial ownership information in the company formation process. And because strengthening anti-money laundering and counter-terrorist financing regimes internationally directly benefits the integrity of the U.S. financial system, my office works with others in the U.S. government through the Financial Action Task Force, the IMF, the World Bank, and the United Nations to encourage foreign jurisdictions to implement measures to combat illicit finance. I began my testimony this morning by noting that the U.S. is home to one of the strongest anti-money laundering and counter-terrorist financing regimes in the world. In order to continue as the world leader in financial integrity, something we can and must do, we are obliged to push ourselves to identify where we can do better and to work tirelessly to get there. Today's hearing is one important step on this road, and I look forward to continuing to work with this committee to achieve this critical goal. Thank you.
Thank you very much. Mr. Cohen, Mr. Winchell.
Good morning, Chairman Levin, Ranking Member Coburn. Thank you for the opportunity to appear before you today and discuss the efforts of the U.S. Immigration and Customs Enforcement to combat transnational criminal organizations and the illicit proceeds used to fund their criminal activities. Over the past 2 decades, transnational organized crime has transformed in size, scope, and impact, posing a significant threat to the national and international security. While the globalization of organized crime is not new, the magnitude, pace, and violence accompanying the illicit activities is alarming. For example, in the past 5 years, we have seen an unprecedented level of drug-related violence south of our border, which has claimed over 47,000 lives since 2006. The fight against transnational organized crime is one of the highest priorities of ICE. With the most expansive investigative authority and the largest investigative force in the Department of Homeland Security, we work closely across agency and international boundaries with our law enforcement partners, creating a united front to disrupt and dismantle transnational criminal organizations. This is aided by our expansive global footprint. With a force of nearly 7,000 special agents assigned to more than 200 U.S. cities and 71 offices in 47 countries worldwide, our domestic and international network of agents all work in concert to target transnational crime. One of the most effective methods of dismantling transnational criminal organization is to attack the criminal proceeds that are the lifeblood of their operations. In fiscal year 2011, Homeland Security Investigation Special Agents initiated nearly 4,300 financial investigations, resulting in nearly 1,800 arrests, over 1,000 criminal convictions, more than 7,700 seizures worth approximately $359 million, including $331 million in currency and monetary instruments. In 2010, ICE initiated a financial investigative project in the state of Arizona following an increase in cash activity at financial institutions along the U.S. and Mexican international border. As a result of recent changes in Mexican financial regulations, many criminal organizations were forced to explore new ways to exploit legitimate financial systems in order to launder their proceeds. A new trend emerged known as the repatriation of the U.S. dollar, and coupled with the Mexican black market peso exchange, has led to an increase in identified U.S. currency along the southwest border region. In the last year and a half or so, approximately $2/3 of $1 billion in the form of outbound international wires or cashier's check purchases from border branches of U.S. financial institutions, mostly to Mexico. In 2005, ICE initiated Operation Firewall as an effort to raise worldwide awareness of the dangers posed by the cross-border movement and smuggling of illicit funds. Operation Firewall targets methods used to move and smuggle currency by focusing on all aspects of illicit cash movements. Since its inception, Operation Firewall has resulted in more than 5,700 arrests, totaling more than $553 million, and the arrest of 1,182 individuals. These efforts include 367 international seizures, totaling nearly $258 million, and 253 international arrests. In August of 2009, ICE officially launched the National Bulk Cash Smuggling Center, also known as the BCSC, as a 24/7 investigative support and operations facility. Since its inception, the BCSC has initiated over 500 criminal investigations, resulting in millions of dollars seized. The center has also provided training and outreach to over 21,000 federal, state, and local law enforcement. ICE's interaction with the financial institutions from an anti-money laundering perspective is multi-layered. Through our Cornerstone Outreach Initiative, ICE HSI special agents share lessons learned, best practices, and money laundering typologies with the anti-money laundering personnel from financial institutions throughout the world. As part of these outreach efforts, special agents show how the bank systems and processes can and are being exploited. By sharing this information, the financial institutions are better able to understand the threats, inherent vulnerabilities, and build countermeasures into their training and automated monitoring systems. These outreach presentations take place at local branch banks, locations, as well as through speaking engagements at anti-money laundering conferences such as those hosted by the Association of Certified Anti-Money Laundering Specialists, ACAMS. In late 2009, HSI expanded their working relationship with the private sector through ACAMS to assist bank AML specialists better identify and monitor financial activity related to non-traditional criminal groups. This expanded working relationship allows the members to learn more about current active financial indicators related to those crimes. The members can then incorporate what they've learned into creating models and filters within their AML software to more accurately identify financial transactions indicative of those crimes. The CAM certification obtained through ACAMS is the most widely recognized anti-money laundering certification among compliance professionals worldwide. Since its inception, HSI special agents have conducted over 11,800 cornerstone presentations and trained over 243,000 participants worldwide. This outreach has resulted in the initiation of over 447 criminal investigations, led to the arrest of approximately 330 individuals, 280 indictments, and over $666 million in seized. Recognizing the magnitude of transnational organized crimes, ICE will continue to work closely with our law enforcement partners as well as with the industry to identify potential vulnerabilities that could be exploited by terrorists and other criminal organizations to earn, move, and store their illicit proceeds. I want to thank you again for the opportunity to appear before you today, and I would be pleased to answer any questions at this time.
Thank you both. Let's start with a 7-minute first round. Mr. Winchell, you, in your prepared testimony, talk about bulk cash, and we'll be seeing a lot of discussion of that, about drug cartels smuggling U.S. dollars from the United States into Mexico, finding a Mexican bank or a Casa de Cambio willing to accept the cash, after which the financial institution brings or tries to bring the dollars back to the United States. Now, why would a drug cartel bother to smuggle U.S. dollars across the border into Mexico, only to send those dollars, or try to send those dollars, back here again for a deposit in our bank? To explain that circle. And why is it that that process takes place? I tried in my opening statement to do it, but I'd like to hear you try it also.
The laws that were initiated in Mexico involving the banking industry set certain limits on the amount of U.S. currency that could go into banks in any particular period of time. $7,000 for a business and $4,000 per individual per month, I believe what the figures are. Bulk cash is moved south across the border as the proceeds of their illicit activity in the United States and pooled in Mexico. They're sold then to money brokers anywhere between 4 to 7% discounted rate. That may be Casa de Cambios and others that they use then to move in bulk cash back across the United States border into U.S. institutions and then wired back into Mexico and exchanged at the current rate between Mexican dollars and pesos, in essence completing the laundering process and cleaning the money.
But to put it simply, they can't just directly deposit these drug sales money into U.S. banks because we have a know your customer requirement. Is that correct?
That would be correct, sir. They have to find someone in Mexico that would be complicit with their activity.
But they want that money to be in U.S. banks, to get there and to be laundered.
Yes, sir.
So the short answer is they can't do it directly, so they have to go through this process of sending it to a Mexican bank if they can and then having it returned cleansed. Is that correct?
That's correct.
Now, what is the relationship between the strength of a drug cartel and the ability of that drug cartel to launder money? Is it clear that the more it's able to launder its money, the stronger the cartel is?
Their profits fuel their activity. The more profit they have, in other words, the more legitimate money they can appear to have, the more they can fuel their illicit activity and then diversify their criminal activity. So the larger the cartel, the richer the cartel, the more powerful they get.
But is it also the more power, they'll be more powerful if they can launder that money so that they can then diversify?
Absolutely.
All right. So again, we have all this huge violence on the border. We've got drug cartels down in Mexico and drug groups here as well, fighting for power, bringing violence to their streets and to our streets. And if they can successfully launder money, they are stronger. Is that?
That would be very accurate.
Okay. Mr. Cohen, would you agree that the more a terrorist can get their money through our system, the stronger a terrorist group will be?
I would, Mr. Chairman.
All right. Now, even though they've got new rules down in Mexico, as you just pointed out, I think starting in 2010, are illicit drug proceeds still being laundered into U.S. financial institutions? Mr. Cohen?
I think there's no question that there continues to be a problem with money laundering in U.S. financial institutions coming from Mexico, from the Casas de Cambio and other institutions in Mexico, as well as from other sources where illicit proceeds are placed into the U.S. financial system.
And therefore, even though there's been changes in the laws, for instance, in Mexico, and other efforts made to clamp down on the ability to launder money for these groups, the terrorist groups or drug cartels, it's still going on, and the effort has got to be continued. Can you give us some of the new efforts that are being made, the new challenges, Mr. Cohen, that in this area of money laundering?
Well, to pick up on what Mr. Winchell was discussing earlier, with respect to Mexico, obviously there is a substantial amount of legitimate trade with Mexico and a substantial amount of legitimate U.S. dollars that are spent in Mexico. And what we see is these Mexican financial institutions working with Casas de Cambios and then working with U.S. financial institutions to take in U.S. dollars from the Mexican economy. Dirty money is layered in with legitimate funds and placed into U.S. financial institutions. That continues to be a serious problem even after the really very important and aggressive steps that the Mexican government has taken to restrict the ability of businesses and individuals to deposit U.S. dollars directly into Mexican financial institutions. We've also seen some displacement of the money laundering cycle. So instead of the drug dollars just moving into Mexico, because of the steps the Mexican government has taken, we've seen some of these dollars move further south and coming back into the U.S. financial system from countries further into Central America.
Now, when law enforcement or bank regulators see a bank in a country with drug trafficking challenges transporting large volumes of U.S. dollars to the U.S., is that a red flag that illegal drug proceeds might be involved?
Well, I think financial institutions have in their anti-money laundering programs a whole series of factors that they look at to determine whether what is happening is normal, typical behavior or something out of the ordinary. And whether it's spikes in the amount of bulk cash coming in or other sort of anomalous activity, those are the sorts of things that a well-tuned anti-money laundering program should identify and cause a financial institution to look at more carefully.
Okay. Dr. Coburn.
Thank you. Mr. Cohen, in your testimony you stated that when safeguards are not stringently enforced, illicit actors are able to take advantage of the U.S. financial system. If they were all enforced 100% of the time, basically what I'm hearing is they'd still be able to take advantage of the U.S. financial system. Because when you blend good with bad from a legitimate organization, so what are the next steps to limit that down?
Well, Senator Coburn, I would draw a distinction between the OFAC list, the SDN list, and anti-money laundering programs in responding to this question. A properly functioning compliance program with respect to the SDN list should prohibit anybody on that list from getting access to any U.S. financial institution, because banks can run the filter, run the names, and if a transaction is coming through from someone who is on the SDN list, it should be stopped. Preventing money laundering is a more difficult task, and the regulatory structure that we have implemented and that Congress has legislated through the Bank Secrecy Act and the Patriot Act and other amendments to Title 31 require a risk-based approach by financial institutions to have an anti-money laundering program that is appropriate given the risk that that bank faces across the range of its activities. Every bank is going to approach this in a slightly different way, and every bank has a slightly different risk profile given its customer base domestically and how they interact with affiliates and non-affiliates overseas. I don't think anyone expects to ever achieve a financial system where there is absolutely no money laundering. But it is also the case that when financial institutions don't implement robust anti-money laundering programs across the range of their activities that is appropriately tuned to the risk that they face, that there is a greater opportunity for illicit actors to get access.
So whose responsibility is it to see that the banks do just that?
Well, I think it is all of our responsibility.
No, but it's specific to the Treasury, right? That's a Treasury Department, and who in the Treasury Department is responsible for that? What agency?
Well, my office is responsible for helping to set policy. We have, obviously, the OCC, which is part of the Treasury Department that is a bank regulator, that it undertakes its regulatory activities independently from the Secretary of the Treasury by statute.
Right.
There are obviously other bank regulators as well that regulate other financial institutions.
But it's not necessarily that we don't have enough good regulations. Part of the problem is that the regulations we have are not being monitored and enforced properly. Would you agree with that statement?
Senator, I think that as we continue to work on the issue of money laundering, I think we need to look both at the regulatory structure itself and see whether there are modifications that would be appropriate. And I also think we need to look at how effectively the regulators are overseeing financial institutions.
Well, I think we've seen that. Our investigation is going to show a lot of lack of effectiveness. As a matter of fact, it does show a lot of a lack of effectiveness. So the point I'm trying to get to is we can write all the rules and regulations in the world, but if they, in fact, are not carried out by the bureaucracy assigned to do that, it doesn't matter. And so the whole point is do we write a whole bunch more regs? Do we make it even more complicated? Do we markedly, one of the questions I had for you, I'm not going to ask, I will send all, if I may, Mr. Chairman, send supplemental questions to both of these witnesses. What's the cost of the people that are doing it right? And I'm going to ask HSBC this too. What's the cost of compliance with this as a percentage of the volume in their banks? And is there going to become a point at which it's not worth dealing with us? In other words, can we do it more effectively and more efficiently, and are we doing the right things?
Well, Senator, I think we are looking at, as I said, whether the regulatory structure needs some modification, not to make it more complicated, but to make it more effective. I think we're looking at whether the financial institutions themselves need to do a better job in complying with the regulations. And we're working very closely with the bank regulators across the spectrum of regulators, both bank regulators and regulators in the securities industry, to talk about how we all can do a better job of overseeing compliance in the regulated industries.
Thank you. Mr. Winchell, just one question. I'm going to submit my questions to the record for both of you, if I might, and have you respond to them, hopefully in a timely fashion. You talked about your outreach efforts have resulted in initiation of 950 criminal investigations. Did HIS agents identify the illicit funds, or did the banks?
It was usually the banks that I would think I'd be safe in answering that question. Our outreach efforts are in an attempt to educate them on the red flags, and then they would bring those to our...
So you're getting some response?
Yes, sir.
All right. And does your trade transparency unit include partnerships with countries other than Central and South America?
Our trade transparency unit continues to grow.
But where is it now? Is it mainly Central and South America? Primarily
Central and South America, but it is expanding towards the Philippines and others now.
And one thing I'll ask you, prepaid cards and stored value devices seems to be a new, novel method. I'd love, in the response to my question, from both of you on that. How are we going to handle that one? That one seems even more difficult.
That one is a bit of a challenge for us, particularly as the individual crosses back and forth across the border in bearer form. It's basically a bearer instrument. The greater concern to us are the loadable and reloadable cards.
All right. Thank you, Mr. Chairman.
Thank you very much, Dr. Coleman. I just have one question more. You touched on this in answer to Dr. Coburn's question. Just explain for us, if you would, Mr. Cohen, very simply, what the SDN list is, what the OFAC filter is, and how the OFAC filter relates to the SDN list, and why these are important.
Sure. The SDN list is the compilation of individuals and entities that have been subject to sanctions under the range of sanctions programs that OFAC and the Treasury Department implements. These sanctions programs cover illicit actors like terrorist financiers, weapons proliferators, transnational organized criminal groups, narcotics traffickers, as well as rogue regimes, Iran, North Korea, Syria, and others. Everybody who is subject to sanctions under those sanctions programs appears on the SDN list. This is a list that is published by OFAC, available to every financial institution, and by and large, financial institutions incorporate this list into their compliance programs and screen transactions coming through their financial institutions against this list, because everybody who appears on that list is forbidden from dealing with any U.S. person, including any U.S. financial institution, and their assets are to be frozen. It is critically important that financial institutions run the OFAC list in their filters so that our sanctions programs are effectively implemented. We rely on financial institutions to ensure that those for whom we have applied sanctions are not able to access the U.S. financial system. That makes our sanctions programs, which at root are designed to pursue our most important national security and foreign policy objectives, are as effective as they can be.
How effective is the OFAC filter, in your judgment?
There are some notable examples of situations where financial institutions have taken steps to try and evade the OFAC filter. We have, over the course of the last 5 or 6 years, entered into a number of significant settlements with major financial institutions that all have essentially the same fact pattern, which is that the foreign financial institution was stripping information from transaction messages running through the U.S. as a means to evade their U.S. partners' OFAC filter. Those are very important cases for us, and I think illustrate how seriously we take this issue. But I, at the same time, think by and large, U.S. financial institutions do a good job of incorporating into their compliance programs the list of names and entities that are on the OFAC SDN list and screening transactions to prevent access to their institutions by those who are subject to sanctions.
And will you put in your words, now I asked Mr. Winchell this before, put in your words why it is that these entities that we're trying to keep out of our financial system try to get into our financial system. Why is it that they make this effort, in your words?
I think the simple answer is if you can run money through the United States, it helps to create an air of legitimacy to those funds that makes it easier for you to then make use of those funds for whatever purpose you want to put them to. And if this is dirty money that you're trying to portray as clean funds, being able to run it through the U.S. financial system helps you achieve that objective.
And makes you stronger.
It helps you achieve whatever illicit objective it is that you're trying to achieve, whether it's weapons proliferation, terrorist financing, or any of the other activities that are the subject of our sanctions, all of which we're trying to combat by weakening their financial support.
It helps you achieve the very activities that we're trying to stop.
It does.
Do you have any additional questions?
No, but I would make one observation, is the better we get, the more they're going to want to be here. That's one. And number two is it's hard for us to know what an excellent anti-money laundering system is, because we can always do better. But I would remind us that the cost of that is borne by the banks, which is ultimately the American consumer. And so efficiency in how we do this and the worry about too much in other words, for the next regulation, what are we achieving for it? Cost effectiveness has got to be part of our concern as we look to handle this. Thank you, Mr. Chairman.
Thank you very much, Dr. Coburn. There will be additional questions for the record for you both, and that will be true with all of our panelists this afternoon and this morning. And talking about this afternoon, I think we've talked to Dr. Coburn and your staff about it. The likelihood is that we will need to break at some point here for a lunch. But we'll see how quickly the next panel goes. We thank you both. We thank you and your agencies for the work that you do. It's critically important to our nation's security, and you're excused.
Thank you, Mr. Chairman.
We'll now call our